warm welcome to everyone tuning in around the world to this Commodities Outlook 2021. This forms part of the one-to-one Mining Investment Africa Online Conference, for which you'll find much more content released throughout next week and from the 1st of February at theassay.com and on the various one-to-one social media feeds. While we can't be together in sunny Cape Town, unfortunately, we are able to benefit today from the insights of a stellar panel of commodities analysts whom I'll introduce in a moment. I just want to run through how this session is going to work. Essentially, it's going to be conducted in two parts. The first 30 minutes or so will be a quick fire presentation round. In turn, each panelist will speak and share their outlook on the metal sector performance for 2021 and some of the key challenges to the mining industry. After this, we'll open up to an interactive Q&A session. There's a feature for you, the audience, to submit questions. So if you want to ask the panel a certain commodity outlook, for instance, please use the text box that you should find in the display on your screen, either at the bottom or the top right there. So it's a pleasure to welcome today's panelists. I'd like to introduce Colin Hamilton, Managing Director of Commodities Research at BMO, Michael Widmer, Director and Metals Strategist at Bank of America Merrill Lynch, and Greg Callaway, Metals and Mining Expert at McKinsey & Company. Gentlemen, thanks very much for taking time to be with us today and to present for us. Colin, could I turn to you first to get the presentations going? And I appreciate it's a tight 10-minute slot to get through a lot of coverage, but let's hear your highlights, please.
Of course, thank you very much, Adam. Welcome, everyone. It is great to be able to present to you today. As I say, it's a shame we are not in Cape Town, but I'll do my best to do what I would normally do at the event and talk through where we are in commodities markets. Now, if we think about it, we were sitting here a year ago and saying, look, we're going to go through the biggest industrial recession we've seen in a decade. Where would prices be? And I don't think many of us would have picked where they are today with copper, with iron ore at multi-year highs in many cases. And that owes a lot to the nature of the type of recovery that we've had. So I've plotted up there just global industrial production, always critical to these metals markets. We had that sharp downturn, but it was a very short one. And then we've had what was a China-led, then a more wider Asian recovery, which is now spreading globally. And we're looking at, of course, a very strong year now for industrial production. And we're looking at plus 6% year on year for this year. And that is obviously supportive of metals demand overall, supportive of metals and mining equities. And we've seen that reflected in performance so far. And if we think of it, I mean, where are we trading at? We're trading at a point where we were trying to force a lot of supply offline as we entered the second quarter of last year. Now, many of these prices, and I've plotted on the right-hand side, are the old classic analysis. Where are we versus the 90th percentile? Where were we in March 2020? Where are we now? All of these metals are trying to attract supply online in the short term. We're hitting bottlenecks through the chain, and I'll talk about that in some of the coming slides, but it has been a dramatic turnaround, and it's been a very metals-intensive recovery that we've seen over the past year. So global manufacturing again. So it is recovered very quickly, and we're seeing manufacturing chains get back up and running. There's still some legacy issues there. We're still seeing occasional lockdown pressures. We're seeing logistics chains struggling, but we have seen been a global recovery. China may have led it, but actually ex-China has been recovering quite fast. And actually, in my view, much of the commodity moves that we've seen over the past 3 or 4 months have been down to that greater competition for units. I've just plotted one example there, steel consumption ex-China. Steel, obviously, the great barometer of the global industrial economy, and it is back to positive year-on-year growth as of November, and we'll get some very strong year-on-year growth figures as we head towards the second quarter. Ex-China is still restocking, and with that, where China had the commodity markets to itself for much of Q2 and Q3, now we have that competition coming through. That's when you get commodity price moves. And that's why we've seen the inflation that we've had over the past little while. Now, when you get that type of scenario, you inevitably run into bottlenecks. The raw material end of the chain, still very tight. Copper concentrate terms, spot terms, still at very low levels. Same for zinc. I mean, if we were sitting here this time last year, we ended up with a $300 per ton zinc treatment charge. Now, spot is sitting sub $100 a ton, and it got there very quickly. And what I'd like to highlight, we've had some dramatic moves actually in recent times. I've just plotted on the left-hand side there, price moves since the end of November 2020, and it's all these elements that really can move pretty dramatically when you get into a tight part of the cycle. Ferrous scrap, I use that a lot as a barometer of the physical economy because it's a very liquid spot market, a lot of players involved. Now, ferrous scrap has gone up 35%. We have steel mills closing down in Europe because they can't get hold of scrap at the moment. Again, pressure really coming through in many of these chains. Lithium had lagged through much of last year. Lithium hydroxide is still lagging, but lithium carbonate pricing moving higher. You've also seen spot LNG and indeed thermal coal in China move dramatically higher. So we're hitting many inflationary bottlenecks in global markets. We've moved from almost what was a reflation element towards hitting these inflationary levels. So thermal coal, LNG, semiconductors, a lot of the auto chains starting to shut down, lacking in semiconductors. Good luck getting a container in the world at the moment. Many of the commodities that are normally shipped in containers just can't compete at the present time. The pulp market, because we're all sitting at home, we're all buying goods. We're starting to see pressure coming through there. So all these elements coming through. But when we hit inflationary bottlenecks, well, you tend to see a bit of a policy response. So we've still got governments printing money at the present time. But one thing I always look at, look, there's longer term thematics, and we'll certainly talk about them through my presentation, I think others today. The shorter term cycles. And when China's economy, by the PBOC's terms, is now hitting potential, it's back at its economic potential, therefore they're starting to normalize monetary policy. We will see a slowdown in money supply growth. We'll see a slowdown in total social finance. The property sector is starting to be targeted pretty hard by a regulation, by a clampdown on developer finance. So what has been this strong metals intensive recovery? Well, China's still going to recover as an economy as a whole, but I think you see consumption start to pick up. And as that does so, the metals intensive investment side will start to slow down a little bit more. That does make me a little bit more cautious. I mean, we're getting these are extremely good commodity prices at the current time. And when prices are this good, you tend to think, well, how long can it last? To me, it's not necessarily the case of can we go significantly higher and stay there. In many cases, it's more, where are we in the cycle? Well, China's starting to ease back a little bit. It's going to be a slow process. It's not like we're going to go into a 2015 style deleveraging cycle, but I do feel like that as we sit here 6 months from now, we'll maybe see some of the pressure, some of that competition for units will have perhaps eased back a little. If we look longer term, though, I think the biggest change is that I want to highlight that right-hand chart, copper consumption growth. I mean, this surprises a lot of people when I say it, but ex-China copper consumption is still down 10% on where it was in 2000. That's the nature of the fact that, I mean, China's taking greater share of manufacturing chains, plus invests a lot in its own economy. Well, as we go forward, what we have now is global thematics, whether it be electric vehicles, whether it be renewable energy, that are more metals intensive and that are, as I say, not just based on China. And you can see there many of these base metals and indeed silver benefit quite significantly in the penetration level from the shift that we are seeing. So the longer term thematic, and that's where we're getting all the investor interest at the moment, that longer term thematic is very much there. I was just cautioning the slide before about the shorter term cycles. Now, let's ignore the title because the title that slide's on, but I wanted to talk a little bit about one of the underappreciated elements, if you want, of green stimulus. Green stimulus is talked about an awful lot. It's clear in terms of renewable energy and charging stations. The other thing I think you'll see governments do quite a lot, which is not talked about as much, is look after the real estate fleet. Governments own a lot of buildings. Governments, whether it be their own facilities, their own offices, whether it be social housing, I think there'll be a lot of pressure on governments to go and upgrade that real estate stock. I think you'll see a lot of retrofitting, partly because it creates jobs. Building retrofits generate about 15 jobs per $1 million of spending, according to IEA assessments. And therefore, this is a quick and easy way for governments to get people employed and get economies moving again. And that also has benefits to metals. So if we look at it, I've listed some there. Smart facade installations could help the aluminium market. You'll see installation of HVAC, building ventilation, LED lighting, very good for some of the minor elements like gallium and indium, even heat pumps and solar panels. So it's not all positive. We'll see optical fibers come in and replace copper, but this is probably the area that I think is underappreciated on the building side. One thing that, if I'm going to emphasize one thing, and it's accelerated at the start of this year, really do not underestimate the influence of ESG flows. Look at that chart on the left-hand side there. It's the net flows into ESG and sustainability-themed ETFs. I've basically rounded up that January figure based on what we've seen month to date. That will be more than quadruple what we saw at this time last year. We've seen huge inflows into ESG-backed funds from the start of the year. That is driving a re-rating across. You've seen it in lithium equities already. You're seeing it in copper. You're seeing it in silver now. We are seeing big silver ETF inflows at the current time. We have a lot of macro asset allocation driven money looking for a place to go. And metals, there will be some of that flowing towards metals. It's also changing, I think, how we think about longer run commodity prices. Many of us sitting here think about long-term valuations just based on the commodity price. Well, it'll be based on a whole lot of other things as well. The utility, if you want, of the commodity itself, the form of energy, the type of fuel used, and the social benefit to jurisdiction. So when we're looking at financing and indeed judging projects on a medium to long-term basis, it's no longer simply the commodity price itself. There's a whole lot of other elements involved. I think I've had more or less my 10 minutes, but I just wanted to leave you with the chart I always like to put up, the BMO commodity comparison chart. The y-axis there is potential for short-term constraint. The x-axis potential for long-term shortage. You obviously want to be top right where you can. What we tend to see is we have a lot of short-term constraints actually at the current time. We don't see too many changes in the long-term shortage, but we do feel commodities like nickel, copper, cobalt, well positioned. I've also designated some commodities where I would put them in buckets for 2021. You get very strong yield from iron ore and gold. Some laggers there, particularly the battery raw materials in terms of pricing. We probably do see steel, palladium and zinc peaking out in the short term. But longer term thematic winners in copper, silver, platinum and nickel based on the ESG money coming through. With that, I will pass back to the next presenter. Thank you, Adam.
Thanks, Colin. Excellent, very succinct. And I'd like to hand over to Michael now, Bank of America. Michael, could you take us through your view?
Very happy to do. And good morning, good afternoon, good evening, everyone. In terms of how we see the commodities evolve, we've actually classified a whole subset of raw materials as MIFs, or metals important for future technologies. I think these are all, in essence, commodities that we believe should benefit from decarbonization. And I think it's very straightforward. I think decarbonization in the end is bullish metals. It is bullish metals because you can't just take out fossil fuels of the global economy and have a global lifestyle. You need to put something else. You need to put something else in. And what you put in effectively are a lot of the mined commodities. And Adam, actually, if you stay on that page 2, that just shows you some of the solutions to climate change that we are talking about. There's a whole range of developments and dynamic that do matter at the moment. If you look at page 3, so the next slide, that gives you a grid on what matters there. You do see a whole lot of mined materials on the left-hand scale and a whole lot of applications on the horizontal scale, and the crosses basically show you where you need which commodity. If you look to page number 5, that now starts to put some starts to put some concrete numbers behind that decarbonization scheme. And just to say that decarbonization, if I had mentioned it 3 years, 4 years ago, I think people would have literally fallen asleep already. I think it just wasn't really much of a topic, and it is now starting to pick up pace, which is accelerated now potentially with a change in leadership in the US. When you're looking at the compound annual growth rates for some of the MIFs that we have classified, copper, for instance, just from those sectors that I mentioned in that chart, you could see compound annual growth rates of 1.7% out to 2025. Now, to put that number into context, and that's why I think it is worth highlighting that the future is actually now. Historically, we had potential copper demand growth of 2, maybe 2.1%. If you factor in decarbonization and those growth rates here, that potential demand growth increases from 2.1% to potentially around 3% globally. And again, importantly here, China has been the key driver, and it will remain very important because it's 50% of demand. But and if you go to the next slide, with the decarbonization, we actually think that there's scope for Chinese copper and also steel demand actually to continue to expand going forward. Really, the only sector that I think is a risk here is housing. Beyond that, infrastructure spend, smart infrastructure spend, cars should all continue to contribute to overall demand. So China remains important, but interestingly or importantly, world outside China should now also become more of a growth driver. If you go to page 8, one of the questions that we always get is, well, actually, commodities or metals from an ESG perspective are actually not particularly environmentally friendly because the production processes are quite polluting. And yes, there is some truth in it. You can mitigate that, for instance, by boosting recycling. But ultimately, when you're looking at the products that we're talking about, vehicles, renewables, over the life cycle of those vehicles, you actually have got a lower CO2 equivalent emissions from the new technologies compared to the old technologies. So again, you require the metals. The metals ultimately help the space or to help the global economy to decarbonate. Slide 9 takes a little bit of a closer look now on how the markets are actually shaping up. And the chart on the left-hand side shows you a kind of like the growth dynamic of the copper market. We had peak capex year in copper back in 2013. Miners have cut capex since, and it's relatively simple. You don't spend, you don't produce, right? And that's why we basically see very limited supply growth at the moment. Against that backdrop of potentially structural demand growth, I think that should give copper a lot of support in the coming years. Lithium is slightly different. Again, a MIF, a commodity that should benefit immensely from the decarbonization, but you do actually see quite meaningful supply growth. And I think there's still a lot of latent capacity in the system at the moment. To me, lithium is not that much about lithium price. It is more about volume growth. And I think we have seen some of the lithium producers in China, for instance, performed quite well because they managed to smartly grow their production volumes. Now, looking into 2021 and going to the next slide and actually sticking with supply, right? Copper, for instance, it is an issue, right? Supply is genuinely an issue. The miners have tried very hard to mitigate the impact of COVID-19, but when you're looking at Chile and Peru, there is still continued headwinds. We now have got the first guidances out from Rio, BHP, Antofagasta, and I think they're all doing pretty well given the circumstances. But I have 4.5% supply growth in the model for this year. You may not necessarily get that. Page 12, just a few words on the demand side. I think Chinese demand is slowing. That is true. There is a silver lining. It's a chart on the left-hand side, in that demand growth is actually becoming much more balanced, right? Back in summer, we had one sector contributing to 90% of demand growth. Right now, we have every single sector actually making a positive contribution. Just plugging in the macro data, including fixed asset investment into our copper demand growth model, we actually continue to have support to copper demand. If you put all of that together in a supply and demand model, look on page 13, we actually have got the copper market flipping from a small surplus into a small deficit. And I would just say, moving into a period of economic reflation globally, and being bearish, I think, is courageous, especially when you're seeing the amount of fiscal stimulus that is coming through now world outside China. In the US, we're talking potentially about 6% GDP growth, green stimulus, infrastructure stimulus. In Europe, similarly, second half of this year, you're going to get some of the recovery fund kicking in. So I think the market is constructive still where we are. And then just given that we talk about Africa, I just wanted to throw one more metal into the equation, and it's on page 21, platinum. Platinum has certainly had its issues in the past few years, fundamentally. And again, when you're looking at kind of what happened, well, how we were positioned 2, 3, 4 years ago, it just didn't look particularly good. If 2, 3 years ago I had mentioned the impact that fuel cells vehicle could have on the platinum market, again, I think there would have been very limited interest. What changed the dynamic there really is the hydrogen economy, and that's what we are picking up on here. I think governments, and particularly the EU, has realized that if you have intermittency issues with power, you need to store electricity somehow. Sure, you can use pumped hydro storage, you can use batteries, but there's also an acknowledgement that hydrogen can actually be a great store of electricity and power. And that's, I think, where platinum comes in. The front, or one of the front runners in terms of technologies, the proton exchange membrane electrolyzer. It is platinum intensive. So the more you build out the hydrogen economy, the more you potentially get, the more you support platinum demand. And then on top of that, it's not the passenger vehicles in terms of fuel cells that should push up platinum demand. It is the commercial vehicles, your trucks, your buses, your trains. If you put, and again, the fuel cells there are effectively the reverse technology of the proton exchange membrane. You're putting hydrogen in, you get electricity out, and then you run your vehicles. If you put the electrolyzers together with the fuel cell electric vehicles, you can justify around 4 million ounces of platinum demand by 2030 in a market that is around 8 million ounces at the moment. So actually, structurally, again, quite supportive. And then just to round it off, and before I hand it over back to you, Adam, our price forecasts are on page 22. So in a way, we put our money where our mouth is, and we continue to have bullish copper forecasts. We have platinum bottoming out as well, but generally a supportive to constructive outlook for 2021, and then longer term for all of the MIFs. So the metals important for future technologies, I think they should continue to benefit. And that's it for me. Adam, back to you.
Excellent. Thanks very much, Michael. Very good. Thanks for whipping through. Greg, I'll come to you now to tie us up.
Thank you very much, Adam. For those who don't know me, Greg Callaway, I'm a metals mining expert based out of Johannesburg, but serve clients globally on topics of growth strategy, marketing and sales, and my favorite topic, market dynamics. I also lead our work and thinking around copper and gold. So if we look at where we were last year, very volatile state with prices of all commodities dropping to near the marginal cost to produce in March through to June, and then rapidly rising to record highs or record highs over multi years for many commodities. What we see here is if we index this across a basket, where we stand today is well above anything that we've seen previously. But what I would say is that volatility that we saw last year is something to continue to look out going forward. So what does this mean for the markets? Well, I'm going to take a little bit of a medium-term view on where things are going, particularly because still the conversations that are being had at the moment around investment decision are still around the fundamentals of the markets and where they're going in the future. What we see is when we look at the mining industry as a whole, we think that revenues will continue to rise 30 even to 45% over the next decade. That's well above what we saw in 2011 if you're looking at the base case, and that comes forward all the way through to 2023 if you believe in a strong devaluation scenario. This is a case where the DXY going down to 80 levels that we saw in 2011, bringing copper prices to well over 10,000, and similarly with other commodities. To back that, you've also got technology, which is really being adopted hard and fast by major players and smaller players through the value chain. So how do we get there? Well, we think that there are a couple of mega trends which are really going to shape the industry over the medium term. The middle class in Asia and with China being a global leader in commodities will continue to have an impact. What we see is when we look at commodities historically and their demand, as the middle class has grown, they have consumed exponentially more metal as they've gone through that development cycle. Electrification, recycling will continue to be a key topic. I think we've heard some good elements from Colin and Michael. If we flip it over to the supply side, ESG has to be on every CEO agenda at the moment. Tom Palmer from Newmont, he said last year when it came to generalist investors out of Europe, the number one criteria for investing in gold was your ability around ESG and getting a good scorecard there. And then don't forget, digitization will play a big part in shaping how miners look. I think what we can take away from COVID last year was that it had an effect in shaping how some of these mega trends will impact the markets. And in many cases, when it comes to renewables, actually accelerating the shift and change. If you speak to European auto manufacturers at the moment, they will tell you that their number one priority when it comes to technology and innovation is around EVs and how they get to the market. Largely on the back of what Tesla has been doing. China with their 5-year stimulus packages, big focus on infrastructure, but smart infrastructure be particular. So in many cases, what COVID has done has really accelerated some of these trends in driving commodity demands going forward. This time around, compared to the China boom of the 2000s, where all commodities, both in price and demand, rose strongly. Here we see a differentiated case, largely between your energy materials, which are thermal coal, uranium, and your steelmaking materials, and those that are used in consumer segments such as copper and your EV, battery materials. What I would say is, in many cases, we potentially are underestimating the impact of some of these trends on the market. From a copper perspective, we looked at what Tesla and Elon had to say in their battery day towards the end of last year. They're predicting that your energy demand will be around 20 terawatts by 2030. This is an order of magnitude higher than the 2.5 that McKinsey is expecting. What this means for copper, and just looking at the battery elements and the number of vehicles on the market, is almost a 6.5 million tons more copper demand. And so this will essentially double the potential deficit that we already are predicting in our base case. To give you a little bit of a understanding, it's in the order of magnitude of 20 to 25 Cerro Verde operations or El Teniente expansions what are expected to enter into the market. And so the shift of renewables, electrification, in many cases I don't think we fully grasp the total impact thereof. How do we get there? Well, if we're looking at the supply side, in many cases we forecasting a deficit. The key takeaway here is the amount of incremental capex to growth capex that is required. We think that you're probably going to see a 10% per annum increase in capex in order to close this deficit. We already estimated that there's probably around 150 billion lacking in investments that has taken place over the years leading up to now. So all in all, with the shift towards remote locations, deeper deposits, automation, this is going to require significantly more capex for miners to spend in order for us to have a balanced market going forward. This is going to bode well for commodities. What we noticed that many of the commodities, we expect a more positive outlook, over the coming 5-year horizon. We're already seeing some of the prices like copper, iron ore, gold in fly up. Just to give you a bit of background to how we think about this, we're not talking purely prices here. When we're talking about price regimes, this is McKinsey's way of reflecting on the premium that is above the marginal cost to produce. And so cash costs is largely descriptive of miners making break even, being able to pay their immediate bills, brownfield being able to expand around their immediate operations, greenfield going out for elephant country, finding those new discoveries, the incremental amounts that needs to be looked at in terms of infrastructure to access those projects. And well, life I think speaks for itself. At this price, pretty much any product does become viable. What I would say here is that there is no such thing as a bad commodity, but only a bad project. Really going into the granularity and understanding the dynamics of many of these projects, there are worthwhile, profitable projects across the spectrum. But if you had to push me for a commodity to focus on, my number one choice would be a copper gold project. My number two choice would be a copper gold project, and number three would be a copper gold project. If I think about what's on the CEO agenda and how you then take advantage of capturing the value pools behind these commodities, well, I think there's a couple of elements. One is around growth. This is particularly looking at both your inorganic and organic measures. Particularly towards the end of last year, we saw some major gold mergers playing out, and I think this will set the tone going forward for many players. Many CEOs still slightly hesitant, reflecting back on the hazards of the past coming from the previous boom ending in 2011 and the pressures that they have got from activist investors over recent years. The second is around productivity, and I think technology has a big part to play in how companies are going to shape and improve their margins. It's one of the reasons why, if we look at the marginal cost to produce across commodities, they haven't increased as much as what we saw previously, as companies continue to focus on cost control and taking advantage of the price volatility thereof. Looking at your workforce, you're reshaping how mines are set up in a modern world. This is particularly important. And then previously, I think you could get away with it. In today's age, you're not. This is around the ESG topic and how investors, shareholders, communities pursue you. And I think this will take front and center going into 2021. If I had to bring this back to this conference and talking about Africa, we did some work towards the end of last year to look at technology and how it would shape the industry. Today, large-scale mining in Africa is roughly around a $76 billion industry, employing about 645,000 people. Applying digitization, looking at advanced analytics, looking at process optimizations, and then automation, there's roughly around $10 billion of additional revenues which can be captured by African mining. That said, 70% can be easily done over the next decade just by going for the low-hanging fruit, looking at advanced analytics and process digitalization. But I think the key takeaway here is that if Africa and African mining companies, do not jump onto the technology bandwagon, there's a strong risk that over the next 2 decades, many of the mines will shift to Q4, on the cost curve. This, exposes them greatly to market uncertainties, with many countries having high exchange rate volatility, facing greater financial risk and possible closure. It's probably implies 60% of revenues and 55% of employees could be at risk if they fail to continue with the trend that we see globally in the space. So in summary, we see that there's a long-term structural bull market for commodities, and we are incredibly excited about where commodities are going. This is, however, going to be sharply nuanced by commodity group. The supply pipeline is in desperate need of capex in order to meet demand requirements. This is particularly exciting as companies go exploring for new projects. What the implied deficits across several commodities means is upward pressure on prices, making them attractive. But prices are not the only means to building value for companies. Looking at the full spectrum of tools around growth, around technology, in controlling costs, increasing throughput, as well as ESG will be important. And then lastly, technology adoption in Africa is no longer a nice to have and an imperative for survival of African projects.
Okay, thank you, Greg. That's very good. That takes us to time. Recommendations. I've got a few questions submitted, and I'm going to try and sort of put them in some sort of logical order. I think it might be better just to quickly reel through what our panel feel commentary feedback is on some of the commodity related questions, and then we'll jump on to some of the other questions, but we will get through them all. Colin, the first one that came in was when you showed up your graph, and we'll go through everyone in turn, but what's your thoughts on lead and where does that lie on the sort of comparison?
Yeah, no, it's good. Good question. And Greg made the statement, there's no such thing as a bad commodity. Well, lead is giving a good go at it. It is a commodity that has been substituted out of everything over much of its. And if we think about the lead market now, the biggest challenge that we'll have is that we will have a lot of lithium-ion batteries coming out of electric vehicles over the coming years. That will be a zero-cost competition to back up stationary storage. So these batteries cannot be cycled. There's no such thing as an MOT or a health check for them, but they can go into as backup storage. That's lead acid's domain at the moment. So there's a lot of challenges. I would also flag that if we look at the e-bike sector in China, or the two-wheeler sector, 25% of those are already lithium-ion batteries. That's going to grow over the coming years. India has a pollution problem. They're going to have to go down the lithium-ion battery route for their motorcycles. So you put all these things together, I can get you a market where we don't actually need any new primary mined lead 10 years from now. We can make do with secondary material. Now, obviously, lead doesn't therefore look very good on certainly on the x-axis in my chart. Second order impact of this, of course, the zinc price has to go higher because many of those marginal operations are lead zinc polymetallic operations. And if you're going to stay in business with the lead price going lower, well, we'll need a higher zinc price to justify that. So it's a bit of give and take, but unfortunately, I don't see a great future for lead in the medium term, but there's a benefit from zinc from that.
Excellent. Anyone else want to touch on lead just quickly for 1 minute before we move on to another question?
Sure, I'm happy to chip in. I share the medium-term concerns, but I think one of the questions that we have gotten a lot is like, what do electric vehicles actually mean for lead demand? Putting more lithium cars with lithium batteries onto the road, what does it actually mean for that demand? And I think there's a slight caveat to that question, because you actually still run a 12-volt system on electric vehicles. A 12-volt system is basically all of the ancillary units, like lighting, for instance, in the car, that you do need to keep some of the electronics that are not required to actually keep the car moving. And for the most of it, even Teslas, those 12-volt systems are actually lead-acid batteries. It only becomes an issue when you're starting to move to slightly different configurations, where some of the car manufacturers are looking also to power them up with higher voltage batteries. But for now, I think, I mean, we are still relatively early days on the EV side, but EVs, as it stands right now, does near term at least, I share the concerns longer term out, but near terms, EVs do not necessarily have to have a negative impact as such, an outright negative impact on that demand. Further out, yes, sure.
Okay, there's been quite a few questions come in on PGMs. I'll remind everyone, it was touched on. Michael did a piece on the hydrogen as well, but let's revisit that, if you don't mind, for the panel, and I'll take off a couple of questions that have come in simultaneously. How do the panelists see PGM growth? Is there a particular outlier within the PGMs that will perform well, or which one has the highest supply side risks, perhaps? Anyone want to take it?
Quickly, jump in here. If I'm thinking about PGMs and really the manufacturers looking at the auto sector and the technology they're using, largely, if you're looking at your ICE e-vehicles, it's linked to palladium, because of the technology lag in order to change the chemistries within many of their manufacturing plants. Palladium is going to continue to be the metal of choice, and as long as we continue to see supply issues out of South Africa, I think the volatility and the higher prices, particularly around palladium, and we've also seen recently rhodium and some of the smaller metals going higher. That said, it is counterbalanced by lower platinum prices, which balance out the basket price.
Yep. Anyone else for?
I think it's very great. Yeah, very good point, Greg. It's the lack of elasticity, and it's a lack of elasticity both on the supply and the demand side for PGMs. And when we get tight markets, we've had an auto recovery. We were meant to rebuild palladium and rhodium stocks last year. We couldn't, because the auto industry recovered quicker, and we had the challenges in South African supply. And therefore, we now look at a situation. China is pushing its auto industry very hard this year as part of the consumption measures. And I say that may be bad for investment-led commodities, but consumption, we're seeing local governments issue a lot more auto licenses. That's going to keep these PGM markets tight. So we've got rhodium already at a new record high. Palladium's probably going to head back there in the coming months. And then you've got the focus on the fuel cell side, which Michael so rightly talked to. Not only platinum, but of course iridium in there as well. Two things I'd flag just as a risk. And look, the story is a very good one. Number one, we talked about carbon intensity before. We're talking deep mines here. We're talking Eskom power. Unfortunately, that does not screen well on carbon emissions curves when your generalist investor is looking at them. Second point I'd make, China, no PGM resource, next to no PGM resource domestically. A lot of rare earths. They're working very hard on rare earth catalysts in China. It's not a perfect solution. They're much harder to recycle, but it is something that China's long and controls the supply chain of, and it plays a lot into the dual circulation thematic that we're seeing. So that is perhaps the medium-term risk that we do see. Rather than, we won't see the conventional catalyst changes, but China maybe comes up with, as it has done before, an alternative solution.
If I can just pick up as well, I think on the medium-term risk, I mean, look, palladium in the end is a one-trick pony, right? 90% of palladium demand is from the auto industry, and I think there's various reasons why we haven't seen substitution yet from palladium into platinum. I think the focus was maybe more on the electric vehicle side. Some of the car producers don't even do research on the combustion engines anymore, for instance, right? But ultimately, I mean, just take one case, BASF, for instance, tri-metals catalyst starting to be rolled out next year, full rollout in 2023, more platinum, less palladium intensive. For one-trick pony in a market where actually cars with a combustion engine may not be quite as popular going forward, that is just really, really tough. And at the same time, I think I look at, and by the way, there's nothing to offset those demand losses, I think, then ultimately. When I look at platinum, it's actually not that one-trick pony. I mean, you have got jewelry demand. Actually, for the first time in years, you have year-over-year increases in jewelry demand in China to start with. And at the same time, that substitution from palladium into platinum ultimately should actually also happen. And then I mentioned the hydrogen economy too. So ultimately, I think that you can almost see the roles reverse in where the more EVs you put on the road, the less palladium demand you get, the more you reduce the deficits. And at the same time, the more you rely on hydrogen, the more the remaining ICE cars use platinum-intensive catalysts, the tighter the platinum market goes. And I think that's one of the reasons really why platinum has outperformed palladium already. So structurally, in medium term, look, I can see kind of the roles that we have seen of the last few years between the two metals reverse slightly.
Okay. We must move on. That's excellent. Thank you very much. Vanadium has been raised a couple of times. Let's tick a few of those questions off. Can we get a bit of commentary there? There's a question around vanadium for battery storage, but then also someone's talking about vanadium in regard to its role in steel.
Yeah, I mean, so vanadium historically has been it's a steel-making strengthening element, very important for strengthening rebar. And still does a lot of that. I mean, it's been that in the open. What's interesting, I mean, I'm actually hearing some feedback from the big European Auto Conference. We are starting to see a lot more real high-strength steels coming through, and you're seeing a little bit more vanadium contained there. That's still actually the growth area. Battery storage is coming, but we're talking something that's sub 1% of the market at the current time. So it's really, I mean, it's even smaller than fuel cells are for platinum at present. So it's growing off a low base. There's the growth there. What we've had, actually, interestingly, in the vanadium market is the high iron ore prices have not helped it, because the high iron ore prices have encouraged a lot of the internal Chinese supply into the market. So we've had a lot of that kind of co-product vanadium supply from the titanium magnetite type deposits come through. Obviously, were the iron ore price to head lower, that would actually paint a better picture for vanadium. But it's interesting, you're starting to see, like other commodities, a bit of a run in the price now. Maybe medium-term expectations being pared back a little, but there's still a good demand story there, I would say.
I think building on what Colin's saying, if you're going into the medium term, really the differentiating factor will be around what's your view on batteries, redox flow, batteries, and the adoption there. There are a lot of headwinds that are to be faced, and substitutes for this. But there are certain pundits that are extremely positive on the potential outlook.
Yep. Okay. There's graphite. Sorry, let's jump onto graphite quickly. Any thoughts on graphite outlook? Perhaps graphite's role coming into batteries as well, the cathode material.
Yeah, I mean, it's playing an important role, obviously, at the current time. There is potential substitutes out there. There's always technology developing. It's part of the challenge is getting, look, what will be the anode of the future that we will see, and what role does graphite have to play in that? It's not an area that gets a lot of focus, much smaller than the cathode materials that we see. I've got to be honest, I don't have a hugely strong view on where it's heading towards, but we have had to absorb a bit of capacity over recent years. But if we look at the longer trend, if we're heading towards 25-30% penetration rates over on a 10-year view for electric vehicles, certainly my view is there'll be a portfolio of technologies coming through, and graphite will still be playing a role in that.
I would concur to many degrees. A couple of years, graphite was one of the hot topics as EVs was taking traction. That said, lots of substitutes out there. It will have its place. How big that place is in the future is to be seen. That said, if you find a good end application and it has traction, it has its own, I could see players doing well in a niche space at the moment.
Yep. Okay, let's move on to some of the more nuanced questions. How much bear case investment insurance on metal demand prices should be used for 2021 to cover the black swan situation of a vaccine-resistant COVID strain emerging? That was from Paul Rankin. I don't know if you gents can see that one. It's the top one.
I think all bets are off if you have that, but I agree with that. I think that to me is actually the key risk, right? At the moment, the bet really is on economies being able to open up and the fiscal stimulus in the Western world actually being able to get to work. Now, if you actually can't open up the economies, you have to prolong lockdowns, and some of the strains do get even more aggressive. Look, I think the upside really becomes difficult. Certainly, it is a worst case. It is a worst case scenario for the commodity space.
I think it really depends on how you believe this is playing out. What I would say is there's been a strong interest by traders, investors in commodities, and they probably have overheated many commodities as you try and find different investments opportunities to put your money and shift. We particularly saw gold, strong rise in ETFs in March last year, followed by silver, then by copper. So I still think that the investor market in this topsy-turvy world of rollout and in a vaccine, they're going to try and find opportunities for growth and to put their money.
Yep. Okay, let's move on. Supply and demand constraints of different mid-value chain chemicals needed in battery materials. Is that something anyone wants to tackle?
I wouldn't. I mean, there are a lot of elements involved within that, and we've seen some excitement in areas like high purity alumina and various other tends. They tend to be very much niche, not mainstream. So therefore, I mean, what you see though is, as talked before in my presentation about the bottlenecks, and there are some bottlenecks that are common of many things that transfer through, even things like the semiconductor side. That's probably the most pertinent one at the moment, and it plays through into some of these other raw materials that affect other areas, and say things like indium and gallium, and it plays into, I mean, some of these minor metals. When you get a time in the cycle like this, where you've got strong recovering demand in certain subsectors, this is always when you get certain minor metals that tend to have their moments in the sun. And I think that's where to look for some of the opportunities this year. Obviously, getting investment exposure to them is that bit harder.
Yeah, certainly. Okay, had a question about what does the panel see as the best performing commodity of 2021? Copper, gold, perhaps, from some of the feedback. I'm not sure what they mean by best performing, but within your own way of looking at it, perhaps that's price rise. Let's go around the panel. What would be your top pick? Colin, do you want to start us off and we'll just go around?
From today's price level?
Yeah.
Yeah, from today's price level, probably FOB met coal in Australia. This is one of the few that's still trading into the cost curve.
Right. Michael?
I still stick with copper, I think.
Yep. Greg?
From today's level,
what I'm going to say to this is, volatility. I think macroeconomics and trading behavior is going to play a large effect. If you are bullish on a dollar crash, we could see many commodities rise higher. You could see copper going to 10,000 quite easily, back to levels seen in 2011. Similarly, with the volatility and the geopolitical uncertainty that we still continue to have between China, US, and various sanctions. If you talk about a vaccine not hitting the market and being able to be effective, gold could be one of those that shoots. So as long as there's strong demand, tight supply, we're going to see large swings both ways.
Yeah. Okay. Keeping on the point of copper, then there's another question I want to tie in from Daniel Major. There's a lot of positive commentary on copper. Supply deficits forecast, but the commodity price forecast presented are flat to slightly down as per Michael's slide. What will result in this flat price trend?
I'm not sure. We have 9,500 actually in the fourth quarter. So the flat price trend, I think, further out, perhaps when you're looking at the long-term price, that is certainly a little bit. That's certainly a little bit of an issue. But look, I agree with you. I think the issue that we had on the copper market is we gave ourselves 15% upside when we put our year ahead out back in the third quarter. Coming to the new year, we had basically rallied, so we had taken out our year-end target, and so we had to look what we're actually going to do. And fundamentally, I think the market has changed, but we marked the market essentially. I think we basically said, look, we still have a deficit in the market, and therefore further out, we just roll forward our more or less 15% price increase, I think. But I agree with you. I think this is one of the issues. There's a lot of positive commentary out there at the moment, but the forecasts generally don't reflect that.
And I mean, it's fair to say commodity markets have a great way of self-solving over time. We look back over history. I mean, what's going to happen at today's copper price? This is a phenomenal copper price. Let's be clear, we're not expecting it to collapse by any means. It's still going to be, and then Greg put up a great chart showing the industry revenues. I think that's very important. We're in a situation now where metals mining industry is making a lot of money, can reinvest in things in technology, can reinvest in process improvements, and will need to, and can invest in environmental improvements. All these things are very important. What happens at a copper price at these levels? Scrap comes back. You find mine supply from places you never thought of, and you defer or destroy some demand. We're a ratio where substitution will start to be talked about again. So these are all the ways commodity markets have a great way, as I say, of sorting themselves out in time. But what we see for copper is that strong longer-term demand growth trend that I think we've all said is not just a China one, which is the big difference.
And I agree with Colin actually on that. And I think this is really, really important for the copper market. And I mentioned before that I can see potential copper demand growth higher by 1 percentage point. If I put that in by 2025, I actually have depleted inventories. Now, that's not going to happen. I think the market will take care of itself. But the point that Colin made here in terms of getting more scrap into the market, getting potentially more mine supply, absolutely, that needs to happen going forward, yes.
Okay, very good. I want to frame a few questions that have come in through a broader commentary, perhaps. That way we can tick off a few in one go. But coming to EVs and the metals required within that segment and the battery metal complex, if you will, are governments and some of the new targets that have come in realistically achievable given some of the supply tightness that we've had described in the near to midterm? Secondly to that, with increasing emission standards and the PGM loadings, will that take some of the growth away from the EV sector in the near to midterm as well?
I'm happy to pick up on the first one, and I actually give you an anecdotal an answer on anecdotal evidence. I think palladium prices rallied 1,500% from the lows in the past decade. When you're looking at the critical raw materials reports from the European Union, PGMs have been classified as a critical raw materials. You read through the comments. The comments clearly say that you have to tighten emission standards. You have to be better on reducing emissions. Supply may be a little bit of an issue. And the rules tightened. Nonetheless, emissions tightened, and so ultimately, I think I think what you're going to see is that the market, similar to what Colin just said, the market will have to take care of itself. I think the rules and regulations will get stricter. They will get tighter. You see it in the UK. You see it everywhere else, that they're trying to phase out cars. Now, whether that means that you actually have all the supply that you need for that. Look, I think there are some bottlenecks starting to appear. I mean, I wanted to talk about nickel actually in the previous questions with the products going into the batteries, right? Right now, you have a bifurcated nickel market, class 2 nickel oversupply, massively oversupplied class 1 nickel, not necessarily. You can use the laterite ores in Indonesia very easily. I think if you manage to get HPOL to work, or if you don't go all the way down to NPI and use an intermediate matte and actually then produce a battery grade nickel. But at the moment, that's really in its infancy. So how do you incentivize that? Through higher prices ultimately. And I think that is the answer to the solution. Recycling clearly also as well. And I think, again, take the opinion, you will see a lot of initiatives at the moment that are trying to set up the recycling networks that we clearly don't have at the moment for some of those industries that are very young.
Colin or Greg, do you want to try?
To build on what you were saying, I think if I'm looking at the PGM space, PGMs aren't going to go away. It's not like EVs take up 100% of the market, as of tomorrow. There's a slow, transition. Yes, it picks up, post 2025, and we see sort of some headwinds. But then you talk about, what's the implications of, hydrogen. We know that's been, a lot of interest has been put into that over the last couple of years, and a lot of money is being invested in looking in how PGMs, in fact, across the hydrogen value chain, are used in each of the steps for various applications, from the catalyst to the storage, and various mechanical components. So there will continue to be a market in some shape or form. And I think you were talking about the nickel market. I think you hit the nail on the head. The differential between class 1 and class 2 nickel, and how you can bring that class 2 to the use in batteries is going to be around HPEL and the workability of that. Otherwise, it's going to push up. If it's not going to work, and you're going to have very expensive capex costs in these plants, it will push up nickel prices higher.
Yep. Okay. There's a question around ESG factors here, and I think everyone touched on ESG taking a lot of capital out of the sector, perhaps, but also potentially bringing capital in. Is it all environmental that's driving this, and what's your view around what are funds asking in terms of the data points, or can you bring any clarity on whether it's the E or G elements that are proving harder to track at the moment, or need a little bit more amplification?
Yeah, I think it's interesting. I mean, all three matter. Let's be clear. I think the E is easier for people to get their head around. Is more measurable in many impacts, which we a lot more focused on the data on that side. The S is more a case of avoiding the pitfalls. Hopefully not literally, but I mean, it is that case of things not going wrong. It's very hard to. Mining industry is very good at social license to operate in the main. So I mean, that is not something it struggles with. The G is less important at the moment, in my view, for investors, much more important to the credit agencies. And this is where it will become a lot more interesting over the coming years, particularly for, say, certain sectors like gold, where we have not the diversity at the board level necessarily. We have remuneration structures which are not in line with the rest of the sector overall. That's where I think there might be a bit more pressure coming in the medium term, but that's not one for now. I think the E is... all three are important, but the E is the obvious one that people tend to focus on, and what's still a nascent form of analysis, I would say. There's no real defined industry standard yet that people can measure against.
Yeah, I would agree that I think you can look at it from
Colin. What we've been seeing in since the end of last year going into this year, there's been an astronomical and exponential growth in companies trying to figure out what that ESG structure, what the criteria and what the framework is that they need to be working around. So I think once they've got their heads around that, like you say, the emissions is clearly easiest at hand, and a lot of focus has been put on that. I think we talked a little bit about water a couple of years ago, and will remain within that space. But that's probably, if you're looking at 2021, how people are going to structure themselves through the value chain to best answer what's their emissions contribution. And we've even seen downstream players trying to reshape their business model in sourcing to accommodate for some of these differences. For example, if you're looking at open pit versus underground operations, the rule of thumb is roughly 2 to 1 in terms of emission intensities of your underground being higher than your open pit. So those are things that companies across the value chain are trying to grapple around.
Okay, Michael, you were going to chime in there. I think it's a bit of a lag, please, on the ESG.
No, I just want to say, I think one way to capture actually what investors care about is by looking at, by scoring actually individual producers according to ESG, and then look at kind of which producers have performed the best, and then pair that up with the individual ratings, and you do see that it is in fact the E. The companies that have had the best environmental performance tend to be the best performers over the longer term relative to their peers. Now, the issue that we have in the markets, and also from a company perspective, is that there is, I think, a feeling as to what E means, but you actually don't really have kind of the goalpost that people need to move towards. And I give you a very concrete example. Take some of the large cap iron ore producers on their scope 1 and scope 2 emissions. They've certainly made progress, but the elephant in the room are your scope 3 emissions effectively, right? And I think the ESG reporting to some extent tries to factor that in, and I think from an investor perspective that is still a key question. So, does it matter if a miner manages to reduce emissions on kind of the 10% of the carbon footprint that they generate, or do you actually have to look further downstream? I think it's that further downstream there, I think from an ESG perspective, to some extent, there is still a whole lot of issues. And you see the companies, the big iron ore miners coming up with JVs with universities, coming up with JVs with steel mills, trying to figure out on how they can remove actually the carbon footprint on the steel side as well. So yes, the E matters in the ESG. The lack of a generally accepted framework, I think, while there's some in there, but the lack of not framework, but the lack of a generally accepted final goalpost, I think, is still an issue a little bit.
Yep, fantastic. I wanted to come back to one of my questions that was basically around a broader theme around general declining grades and quite a lot of underinvestment, perhaps on the growth side. Of projects over the last bearish period we've had before. Does the panel have any more view on what major miners are going to be looking to do now? Is it simply a case of growth being back on the agenda? And is this going to spur on a lot more M&A now that we have this quite positive, very bullish metals demand environment that we find ourselves in?
I would say that miners, being burnt in the past, are still, slightly, cautious to make sure that they don't make the bad deals that were, previously seen. But that said, I think in order to achieve growth, it's going to come from, particularly, three factors. One is around M&A, and we're going to see a rise in that. We saw a couple of big gold deals towards the end of last year. I think exploration has a place to play, particularly coupled with technology, and we're seeing some great work using drones, using cognitive AI to really accelerate and understand geological ore bodies better, and then the technology in the operations themselves is going to play a factor to try and get that incremental volume addition out. We've seen some good work with process digitization in improving throughput, particularly in the midstream of the value chain through your smelters and refiners. So I think it's going to be a combination of those three.
Yep. Colin, any thoughts on M&A or the growth strategy from here and global?
Yeah, it's interesting. I mean, the mining companies are not being punished for being ex-growth. It's interesting. I present to a whole number of sectors, and when you present to some of the other sectors, they go, "Why is the mining industry so happy to be ex-growth?" Well, it's partly to the point Greg made. I mean, they've been burnt so badly in the past by bad investments, and at the moment, shareholders are happy to see these outsized returns. And the mining company has gone from a growth story to a value story, to a yield story in many cases. Now, that's never going to be forever. The scale always shifts, and it's gone from maybe one extreme to the other. They will come back towards a happy medium. But I suppose if you want to categorize it, again, Greg had a great chart on global mining capex. Back in 2012, every division of every major miner had a project they were working on. Now you might see one, maybe two projects across the entire miner. So I think it is going to be still a bit more cautious, and even internally they'll be competing for a small pool of capital to grow relative to anything else. M&A always tends to lag in terms of the cycle. People don't want to buy now, which might be towards the peak. There's maybe still a little bit of hesitation around how long the strength and apparent demand we're seeing at the moment will last. So I think there will still be an element of caution there. They're focusing now, I think, on just maintaining those high revenues that we're seeing. The margins we're seeing from these companies are extremely good.
I think also capex is clearly very low still out there. I think from a miner's perspective, it depends also a little bit at the commodity that you're looking at. Right, take nickel for instance, a key growth commodity over the coming years. But realistically, even 5 years ago, the big miners had to kind of cross-subsidize their nickel operations because they were effectively loss-making. So at some stage, we just did a little straw poll on when some of the big miners would be happy to start reinvesting into nickel and nickel operations. And I think the range that you got, I think the minimum price that we got at the time was $15,000 per ton. The highest was around $20,000 per ton. Now, we only very recently started to trade into that range, and I think that is one reason why the project pipeline is one reason, not the only reason, but it's one reason why the project pipeline is actually quite empty. And then for the most of it, I think there's always this discussion whether you move ahead of demand growth or waiting for demand growth and prices to rally. And I think take copper, for instance. I can only think of one major producer who, with very large reserves and resources, who would be happy to actually invest heavily ahead of kind of the price increases that we've actually now started seeing coming through. I think the others are still relatively cautious, but the investment is probably going to come. And on gold, yes, M&A is coming, right? We've seen it actually already. I think you've had a very steady flow of M&A transactions in the past few weeks and months, and I think that will likely remain a feature. But again, it's to some extent linked to how gold is structurally, fundamentally set up on the supply side.
Yeah. Okay, I've got to put a hard stop to this in 4 minutes for another commitment on Zoom. But if we're happy to keep going, we can do another 4 minutes, rattle through a few more things. It's pretty good. There's loads of questions coming in. Someone's raised one about diamonds. Do they glitter anymore? This is a good question. We do have quite a few diamond companies that do our one-to-one Africa show, so it'd be good to get some commentary there.
Go on, Michael. This is.
Do I look like the diamond guy? No, but look, I think it's. I mean, you're starting to see how the market is certainly turning around, right? I mean, when you're looking at the recent kind of anecdotal evidence from Anglo de Bear, certainly you've started to see the market turn around. I think there's certainly hope. You have also had some cutbacks on the supply side that has certainly also helped. So yes, I think we've had maybe a little bit of a difficult time behind us, but it seems as if the market is starting to turn around a little bit.
Can I jump to one of the questions, or I can probably answer two together on steel and iron ore very quickly. Steel and demand future price for hot rolled coil in the US. Well, we're second highest level in history for US prices at the moment. There is capacity coming. A lot of US capacity, flat roll capacity being added over the course of this year. That will bring in a bit of normality. Tariffs will stay in place. There'll still be a premium to international prices, but you will see it come down. There's another question on China importing steel scrap. China has changed its regulation around scrap imports. Steel scrap's a very competitive market, though, at the current time. So you will see some, particularly for mills that can't get enough coking coal at the current time. But I do think that China's not going to be a huge player in that market. But scrap generation domestically, in our view, I mean, even if steel production's flat, that means iron ore demand is going down in China. So just be wary of that. This is why, to Greg's slides and to what I think, we will see iron ore prices normalize from where they are today.
Okay, very good. We've got 2 minutes left then till I need to shoot. Flipping to something perhaps quite different then. Someone's mentioned about Tesla's move into mining or the statements they've made. But what's everyone's views then on maybe OEMs owning more of the value chain? Is this realistic? Is this grandiose statements from certain CEOs? Could it be helpful to the industry for OEMs and miners to come closer together?
It comes in nuances, right? I mean, owning part of the supply chain can mean an awful lot of things, right? I mean, whether a miner actually, or whether a car manufacturer actually wants to own a mine, look, I'm not sure whether I would necessarily go that far. Whether you want to have long-term contracts in place with your producers, which I think the model right now, absolutely, I think, and you're seeing that. Whether you can have innovative structures where you do, say, a streaming transaction, for instance, to fund some of the mining developments. Look, I think there is certainly scope for something like that. Also, it is potentially still very early days. But given the concern that we do have about some of the raw materials, certainly from a car manufacturer's perspective, there is certainly all incentives here to make sure that you're not running short of the materials that actually keep the wheels turning going forward, right?
Okay. Unless there's any other
creative partnerships, along the value chain, we're going to see that evolve, over time, being, somewhat different to where we are at the moment. So, Tesla, I think, is pushing the boundaries and making companies across the globe really think about how they do business. And maybe some of it works, maybe some of it doesn't. But I think the questions at the moment, everything's on the table. to look at. So let's wait and see what comes.
Yep. Okay, unless there's any other burning points, I'm going to have to wrap this up and get to the next appointment. But thank you very much, Colin, Greg, Michael, for your time. It's really been great to see minds at work there covering a whole host of topics. There'll be some materials and a replay of this available for all of the participants and people that didn't manage to make it. And this has been a really good, insightful session for one-to-one mining investment in Africa. So thanks everyone for participating. Take care.
Thank you. Bye.